Welcome, everyone. It's time for a Patreon exclusive. I appreciate you all being here. This is a little different because I'm not on the camera, so you're just hearing my voice. You're not seeing me. And I thought it would be fun to try this out one time on the AMA section because, frankly, doing the full video where I'm in video takes a ton more storage file. And because of that, the upload to YouTube takes a lot longer. It takes a couple hours to upload it, which makes it so that I release this video way later in the evening and the whole process just takes a lot longer. So I thought I would do a screen recording. That way we can get this video up a lot quicker. I'll be doing more normal video formats in the future, but I thought for this time, I'll do a quick screen recording. This will be kind of like the OG Joseph Carlson, the original channel type of thing. So let's go ahead and do that. First, I want to get rid of this. No, I don't play any Overwatch, so we'll hide that. Discord, by the way, is they're running ads in Discord. I don't know if you've noticed that, but now they have like ads and integrations with games that they're doing all the time. And on a total side note, if Discord as a company ever goes public, I think it's one that I'm going to buy. I think it's one that I will buy the IPO. I would pay a seemingly outrageous price because just imagine the treasure trove of data they have. It is incredible. These are all private channels, a private Discord, and they have endless conversations on dividends, analysis, growth companies, crypto, options, retirement accounts, fixed income. You only have access to this stuff if you're the owner of Discord, or if you have, if you own all these private communities. Unlike Reddit, all of these communities on Discord are private. So if they IPO, just imagine how much they can sell all this data to AI and, to different companies that want to harvest the data. So just on a total side note, if they ever IPO, that's one I'm going to be extremely interested in because I think they have a ton of untapped potential. But pushing that to the side, sorry, that's a little bit of a rambling here. Let's go ahead and jump into the Ask Me Anything. This is a channel on the Discord where you get to ask questions. I answer them. I may skip a question here or there, but that's only if I've just recently answered them in a different AMA or if it's been a question that I've just answered a lot of times. So let's go ahead and jump in. We'll start off with the most recent one here. Malik says, "Hey Joseph, hope you're doing well. I wanted to ask you, would like to see a stock split on Booking. What are your thoughts on the stock splits? I know that it doesn't change anything particular with the stockholder, but do you believe that the lower stock price can drive eventually the price up, as it would be more liquid and more accessible? Is there any particular studies for these kinds of cases?" I don't know the studies behind it, but I do have some basic conclusions, and this is completely based off of just some simple observations about stock splits. I think they basically do two things. First of all, they don't intrinsically change the value of a company. So whether you divide the share count of a company by 10 or 20 or 1,000 or 1,000,000, that doesn't make the company intrinsically worth more. But it does change mechanically the amount of liquidity in the stock, which can affect stock pricing. So it can make it easier to buy something. When it's easier to buy something, when it's more accessible, when it's easier to gain access to something, that may make it so that it has more inflows. So with Booking Holdings, there's a couple benefits I actually think to having very large stock prices like $5,000. It just makes it so when somebody buys it, they're just serious about it. They really want to own a share, like they really want to buy a share. And so typically when I see somebody buying a lot of a really high price stock, I think it makes for almost a more stable stock. One that's less liquid, yes, but the less liquidity makes it so it almost is easier. Like I just feel like you have a more serious set of shareholders in it. When you turn the stock into like a $20 stock, then you get a lot of people that buy it and sell it and trade it. I think there's way more options and, there's more robotic tools and day trading and that type of stuff involved in the company. So I actually don't mind Booking Holdings being a really expensive stock price because I'd rather have only long-term shareholders that are very serious about owning the stock in the stock. And I believe that's the reason that the owner of Booking Holdings, the CEO of the company, prefers it that way as well. The downside is that when you're trying to pay people in stock-based compensation and incentivize employees, it makes it logistically more difficult. So when he's trying to issue out shares and an employee has worked enough to get 0.3 shares, what do? They'd have to have a brokerage that has partial shares, which a lot of them don't have. So in that case, he's saying logistically, they're probably going to have to do a stock split at some point just for the mechanics of how they pay employees and, to offer a little bit more liquidity. So there's ups and downs to each of it. I don't mind Booking Holding trading at a $5,000 share price. I use M1 Finance. It does offer fractional shares, but it just doesn't matter to me. And I think if I can buy a company and it has a little bit just more steady long-term shareholders in it over the day traders and the robots that do all the day trading, I'd prefer that. Now, moving on, we have a question here from Alex Stone King. Hey, Joseph, I'm guessing you don't play the lottery, but if you did and you won, say $100 million, would you take the money up front or the 20-year annuity? What would you do with the money? What percentage would you deploy to your portfolio right away? Sure. So first of all, I would never play the lottery because I believe the lottery is overall a very exploitive vehicle. Warren Buffett has talked about this, so this isn't a completely unique take from me, but I 100% agree that the lottery is basically a tax on people that are lower income that have dreams of becoming rich because they feel like it's unattainable. So imagine you're born in this very low income environment. You don't have a huge network effect. You don't have high achieving people around you. You don't have great examples. And so you're just kind of stuck in this system of a very difficult environment to get out of. And then you have this lottery, this idea that you might be able to win something where you get $100 million and you can just dream of escaping it. In those circumstances, it totally makes sense that somebody would pay money in the chance, just a chance, an offshoot that you might be the one to win big. But what people fail to recognize is the significant statistics of the chance of you winning. It's so incredibly minimal that you're basically throwing away what little money you have to something that is insanely unlikely to happen. I mean, you're more likely to get struck by lightning like 10 times in a row. The statistics are completely staggering. It is a tax on people that is exploiting the dream of becoming rich. And I don't like that because disproportionately, the lowest income quintile in the United States are the most likely to buy lottery tickets. So the people that need their money the most are the ones paying the most for lottery tickets as a whole. They're the ones funding the lottery. Low income, desperate people. Now, overall, those same people need their money more than anyone else. Statistically, they're not going to win. So, they're just not going to win. And the people that do win have never dealt with a great deal of money before. So they end up ruining their life with it anyways. So even the winners, in most cases, aren't bettered because of it. It just overly complicates their life. They don't know how to deal with money. They didn't grow money in a natural way where they've learned how to budget and deal with the responsibility of it. So it also has major consequences. And most of them find themselves being poor in the first place, or even after winning the lottery. A lot of times it makes their life worse. So I just don't think it's a great system. I think that the states like it. States in the US love it because it's a huge taxpayer generator or a tax revenue source. So they view it as a revenue source that they can use that money and distribute it elsewhere. But overall, I think there's a lot of reasons to objectively think that the lottery is not a good thing for society right now. I'm not saying it should be illegal. I just don't think that it's a net benefit. Now, in terms of what I would do, when you look at the two options here, what would you do with the money, upfront or the 20-year annuity? Always upfront. If you have options like this, always upfront. Money today is worth more than money tomorrow. It's worth more than money a year from now or 10 years from now. Plus, you have a risk, the element of risk. If you get even a lesser amount of money upfront, you can invest that money. You have it in your accounts. You have it in your bank. It's yours. The 20-year annuity, there could be changes. Just because that's an IOU, it doesn't mean that they're going to pay you. They could change the rules later down the road. Even if it's from the government, nothing's truly guaranteed, right? We have a big problem with the government promising certain benefits to people, and then 10 years down the road, we go, oh, we can't pay for it, so we might change the rules. So in the case of money, it's always better to be paid sooner than later, to have the money in your checking account today rather than next year. That's why when you give out money as a loan, there's an interest rate attached to it to compensate for risk. So for my situation, I'd much prefer to have that money up front. I'd be able to invest it I'd be able to put it somewhere where I can, invest the capital safely and let it grow. I could live off of a portion of the interest payments and have a very happy life and be able to generously help other people along the way. Now, for most people, ironically, if you don't have any clue how to deal with money, then it might be better in that situation for somebody to have it over in payments so that they can at least not burn through all the money at the start, right when they get it. But yes, for me, I'd take it up front over the 20-year annuity. What percentage would you deploy to your portfolio right away? All of it. I'd put all of it in my portfolio. If I got $100 million, about 60% of it would go to various taxes. So I'd walk away with maybe $40 million. That money would go into my portfolio, and my goal would be to get it back to $100 million in 5 years. I would want to double that money. And my portfolio would look very similar that it does today. I might open up a couple new positions. Maybe I put a couple million into Uber or something. But no, I'd be buying a lot of Amazon, a lot of Google, a lot of Microsoft. I would want to buy a little bit more Costco. I'd want to buy a lot of the great companies I own today, especially the ones that I think are the best deals. Would appreciate your current thoughts on Visa and MasterCard. Thank you. I could look at them. Let me take a look here. I haven't looked at Visa. Let's take a look at Visa here. I haven't looked at this one in a while because I just look at MasterCard so frequently. When I look at Visa, what I'm looking for is any changes to the business. With Visa and MasterCard, what you're doing is you're investing on the basis that things will stay the same. You're basically saying, is there a constant in this world where a big part of society is going to want to use the digital networks of Visa and MasterCard to fulfill transactions? And are they going to continue to take market share from cash? Are they continue to adapt to all the different various markets? And for the most part, I think it's staying the same, which is a good thing for Visa and MasterCard. I think overall, the businesses, the competitive threats, the industry is mostly the same. So when I look at either of these companies, I think they're mostly the same. If I go to them and I take a look at the valuation, 3% free cash flow yield, 33 PE, I don't think they're screaming deals. I don't think that they're overpriced. If we look at the historical valuation, this is basically where they've been trading. They're expensive in 2021, not the time to be buying it like many companies. But ever since then, just take a look. They're about where they've traded. I don't think there's any big step changes to the business over this time period. So I think it's neither an amazing time to buy these companies or a bad time. I think that you could buy them right now and be just fine. So just overall, I think they're about where they deserve to be. I think they'll from this point, I still think they're likely to slightly beat the S&P 500 over a 5-year period. What do you think about MongoDB and Coca-Cola Consolidated? I haven't spent a lot of time on either of those companies, so I don't have time to go through and do a full analysis on them. I've looked at this one before, but I have not dove into these ones. I don't like to do the Jim Cramer thing and just give a buy or sell on a company that I'm not really familiar with. These two, I'm not familiar with them enough. Hello, Joe, new member here. I'd like to know your thoughts on two Latin America stocks, their ticker NU and MELI. NU is a fintech bank, kind of like SoFi, but with more clients and presence in Brazil, Mexico, and Colombia. MELI's like Amazon in the e-commerce segment and also expanding into financial credit institutions. I'm bullish on both companies. More in MELI, but always hearing the respective opinions like yours would help take me to the second look from different point of views. Thanks so much in advance. I don't know as much about NU. I've seen that one. There's a little buzz on the Discord. People are looking at it on the Discord community. That's typically when I start taking a look on it, when I start making KPIs on it. MELI's one that's been talked about a little bit longer. I don't think it's the next Amazon because so much of Amazon is stuff like AWS, massive cloud hosting business that MELI does not have to anywhere the same scale. I would say it's like, what is that company? There's a couple other, online marketplaces that are big outside of the US. And for me, it's tough because the online retail space is interesting in Amazon, but I really like the whole package. I like how Amazon has Amazon Prime Video. They have the membership. They have the advertising business layered on the online business, and they have AWS. There's so many parts of it that I like. I don't know if MELI has all the same ingredients, but it could be far more fast growing for its valuation. So I'd still have to look at that one. And then SoFi, I don't own SoFi. So when you say it's like SoFi, but it's in Brazil, my thoughts on fintech companies is I think that there's far more competition than most people believe. I think fintech is highly competitive. There's so many like PayPal companies, SoFi, Ally Financial, and they're all competing with JP Morgan Chase and all the tools they're building out. JP Morgan Chase, these huge banks, have enormous efforts going into fintech strategies as well. So to me, it's highly competitive, but that doesn't mean it's a bad company or that you're not going to get attractive returns. These are two, again, that I haven't spent as much time on. Hello, Joseph. Can you do a simple analysis on Meta at $600? Is it a good buy-in in your opinion? Let's take a look at Meta here. I haven't looked at this one in a minute. Meta is going from that year of efficiency to now the year of inefficiency. We went over that in the next second look. Mark Zuckerberg is spending a ton of money. Now, here's my thoughts on Meta. Overall, the moat has been far more resilient than I think anyone could have even thought. Social media is quite the moat. The network effects are in full, and they're fully intact right now, meaning that they keep gaining users and they keep making more money with the amount of users they already have. Family daily active people continues to increase past 3.35 billion. The amount of revenue per user continues to go up. It's incredible, the moat of this company. As long as that stays consistent, that people are addicted to social media platforms that Meta controls, they're unwilling to leave them, and even new and younger people are signing up for them and using them, this company is going to be a good investment. You can basically ignore everything else. If people continue to be addicted to their social media platforms, like is being proven here in the data, then they're going to find a million ways to make money. The people at Meta will figure out ways to do it with the advancement of artificial intelligence. Now, the risks that I would highlight with this company is even though it trades at a decent PE ratio, a 23 and a 3.5% free cash flow yield, like Amazon, it has an enormous amount of stock-based compensation. So look at the free cash flow here, $54 billion. When you look at stock-based compensation here, 17 billion of that is stock-based comp. So there's a lot of dilution in paying employees, which is okay. When you go from the free cash flow per share or free cash flow to the free cash flow per share, you can see they're doing a lot of buybacks as well. So Meta is diluting to pay shareholders and then doing buybacks as well. The biggest risk is probably a combination of the stock-based compensation and their huge spend into CapEx. So very similar concerns as you would have with something like Amazon. The concerns would be that they're going to dilute a lot, they're going to spend a lot on servers, and they're not going to get an attractive ROI. Their free cash flow as a result will suffer from this, and it will become just kind of a CapEx heavy business. Because when you have a business that has $37 billion of CapEx and it has revenue of $164 billion, you're getting close to that past that 20% mark, where over 20% of the revenue is going to CapEx, which is more than railroads. So I don't want to paint a negative picture here. Meta's been way more resilient than I would have guessed. I think if they continue to have people addicted to the platform, overall it will be a good investment. It's very similar, by the way, with Amazon. I just think that people are too addicted to shopping and using it. It's too convenient. It's become a touch point of human civilization in the US and in Europe. People just use it every day. And as long as that continues, Amazon's going to find ways to monetize it. So I view it as similar, these type of things that continue on forever with Meta and Amazon. All right. A very broad question. How will AI influence the world beyond the short-term expansion of business margins? AI is making businesses more efficient, leading to higher revenue per employee as fewer workers are needed. If businesses can operate with fewer and fewer humans while still relying on human consumers to buy their products and services, how can this be sustainable? We will likely see rapid market growth as businesses become more efficient and profit margins increase. My question is, what do you think will happen next? Who will benefit over the next 50 years? Okay, so I'm going to restate something that has happened since the beginning of modern civilization with modern efficiencies. Every time there's been some marvelous thing that's made business more efficient, meaning you can have fewer people accomplish more productivity, more output, that has never ultimately led to fewer people being hired. Think about it. You have, the automobile against the horse and buggy. You have assembly lines at Ford making cars an assembly line, making it so the output was way more efficient per employee. That didn't make it so there are fewer people hired. You have farming. Farming used to be done by hand. Then you have hydraulics and tractors, and you have automated ways of doing it. Now it's done by satellite and all the incredible tools. Farming used to be about 30% of the jobs in the US, and now it's around 4%. Are there fewer people working now? No, because what happens when businesses become more productive, when they have more output? They have more excess profits. When businesses have more excess profits, they not only do buybacks and dividends, but they also expand into different categories and territories. And, a business that's stuck in one lane might say, hey, let's invest in EVs, let's invest in robotaxis, let's invest in satellites, let's invest in this and that and this and that. They do it with their excess capital, and they need more employees to run those businesses, more employees that can do it more efficiently. So excess capital is not just returned through dividends and buybacks, it's used to expand businesses into different verticals, which require more employees. You can look at it, even a really at-home example would be Qualtrim. I pay a developer to code things. He is more efficient now with artificial intelligence. It helps him solve coding questions much faster. So we can just get more done. But does that mean that I'm going to pay him less? Do you think my goal is here to save, I paid him $100,000 last year, I want to pay him $80,000 this year? No way. That is not my goal. My goal is to just work more hours, get more done. I want more features. We want to grow this thing. And then when more people, we get more customers because we're coming out with features at a more rapid pace. I want to hire a bigger team. Now I want to hire someone to take care of KPIs, to put in all the data, to validate it. I want to hire someone for customer service because the amount of people are here. So it makes it so you want to grow businesses faster. Another interesting point, there's an interview with Ted Sarandos, who's one of the co-CEOs of Netflix. And he was asked a very similar question. He was asked, with artificial intelligence, are you expecting to have a huge amount of savings? Are you going to save so much money on content by becoming more efficient, by generative AI saving you on CGI costs and all these different costs? And all the questions were centered around savings. Ted Sarandos said, you know what? He said, it's always the questions around savings. You're going to save so much money. The company will become more efficient with AI. He goes, that doesn't excite me. My goal is not to make Netflix as efficient as possible. What would excite me is if AI can make better content, can improve the content. If we can just make it better for viewers, better quality, better story writing, better, more interesting camera, whatever way, improve the quality to make better movies and TV shows. His entire goal was not to try to save money with AI. It was to make Netflix have even better content than it does, to improve the quality of the content. So with most businesses, I think there's going to be huge efficiency gains with artificial intelligence, but the companies that can really use it to not just make things more efficient, but to make their tool set way better are going to be the companies that have a huge advantage. So with Amazon, it's doing things like summarizing the reviews. That makes the experience better. With Qualtrim, summarizing earnings call transcripts, giving you a precursor of what to look for with the next upcoming earnings calls, highlighting the risks and the moat of different companies. If we can use AI to benefit it, that's a lot better than trying to use AI to save a buck with my developer. I don't care as much about saving $10,000 or $20,000 with my developer as I do making Qualtrim a lot better. So I think it's a wrong perspective. Most people look at this through efficiency. But the biggest companies that will benefit from AI are not the ones that can save 10% on their workforce. It's the ones that can dramatically improve their product suite with artificial intelligence, dramatically add and layer upon value on their business. So those are the ones I'd be more focused on. And I don't think there's going to be massive unemployment because of artificial intelligence. There could be some rockiness, specifically with robotaxi, where there's an industry that gets disrupted. But remember that just 10 years ago, Uber wasn't even a thing. You know, these businesses, there's evolvement to the economy all the time. As long as capital is getting traded around, people are going to want to invest and create new opportunities and verticals and jobs. I feel like I'm missing some context here. You say update. Is there like a first part of your question here? Maybe? I don't think so. Okay, say update. She said she was unsure on a second date, but confirmed that I am indeed a nice, handsome man. She was unsure of the long-term match, but that my date idea going to an art gallery was very good. I want to know your opinion. Would you take this as a no or be strong and persist to a real love story where the peasant gets the princess and at the end of the book? It depends on how much you like her. I mean, if you want to, go after her, go after her. But if you I can tell when I was dating, I could tell early on if I have any great future with a girl. So if I go out on a date or two, I could figure out this has a chance or this doesn't. This is not going to go anywhere. So with my now current wife, I was after we went on a couple dates, we started just spending every minute together, 24/7, all day long. It wasn't dating. It was just like just spending all our time together every single day for the next year. And after that, I was like, let's get married. You know, we're like it's going to end up this way. I don't want to spend any time with anybody else. So it happened pretty quick of where I knew I wanted to be with someone. And then you have to spend enough time with them to get to know all sides of them, because people can put on a little bit of a facade for a couple months. Once you get past the 2 or 3 months spending time with them, then you start to see all sides of them a little bit. So, but yeah, I think if you really like her, go for her. But I think you should be able to tell if you have a long-term future with someone. I don't think, in my opinion, dating just to have fun is not that fun for me. Like if I've determined I have no future with this person, I don't want to keep going on dates with them. I don't think it's just fun to go on dates with someone that you're never gonna, there's no chance of having a long-term future with them. But there's my dating advice. I'm probably not the one to ask for dating advice, because I met my wife the old-fashioned way, in person, no dating apps. So that's a different life there. Now people grow up and they have all the dating apps, whole different world. I'm maxed out on Amazon and Google. Okay, so we're off of dating advice. We're back to stocks. This is a little bit more of where my specialty is. These two are heavily concentrated in my folio. Are these two other stocks you think are good, undervalued buys right now? Are there two other stocks? A couple that I would highlight that I think are worth looking at. I really think ASML is a quality company. Now, I would not put my whole net worth into ASML because there are risks to it. It could end up being a poor investment. With every investment, there is a probability distribution. So if you don't know what that is, just look up a probability distribution chart. And it means that lots of things can happen, but there's more probabilities of this type of outcome happening. The majority probabilities are that ASML is undervalued. Over time, it will have very attractive but lumpy returns to investors. So over the next 5 to 10 years, especially the next 10 years, the stock will probably be worth a lot more than it is today. They're a combination of a highly profitable company, selling a lot of their devices, and doing a lot of buybacks. So that's the most likely case. But it's not the perfect investment. There's risks to it, regulatory challenges, technological challenges. So it's not one that I'm going to put my entire life net worth in. Nor is Google. Google has risk as well. I think it's low. But notice I'm not all-inning any of these companies. Out of the three, I think Amazon is the least risky. I think it's the most certain that it's going to be worth more in 5 years. But there's still even risk to Amazon as well. They have massive competitors with Walmart that's pushing heavily into online goods, Walmart already has massive distribution through all their Walmart locations. They have 2-day shipping on a lot of stuff now. So Walmart.com is starting to look a little bit more like Amazon, but I still think Amazon is the least risky out of the three. Other companies, if I look at my holdings, let me bring it up here. Let's go and take a look at some holdings here. We'll go to currently own. Okay, so we have Amazon, ASML. Booking, I think I think it's decent. I think now's a decent time to buy that one. I think it's undervalued over the next 5 to 10 years. Google, I think is, if you don't think search is going to get too disrupted or lose too much market share, I think that one's good. Moody's, I don't think is undervalued right now. It's just not there yet. I think S&P Global is a great buy right now. Attractive long-term returns. Texas Roadhouse, I think there's right in the middle. I think that one's great. Microsoft is probably a little high. Netflix, I would say my buy-in price, if you're going to buy a big position new, is somewhere in the mid 700s, 720, 730 preferably. But I do think Netflix is going to be a very attractive company in the long term. So it's one that I'd put on the watch list and buy it when it dips. So these are ones, I think a lot of these are good. There's some of them that I'm a little, I'm just holding out a little bit. I already own a lot of Salesforce. The last earnings report wasn't amazing. The revenue growth is slowing down. So that one I was a little bit disappointed with the last earnings report. Costco just trades at way too high of a valuation. Simply put, it's just too high of a valuation to see super attractive returns from. I'm not selling it, but I'm not buying it right now. MasterCard, I think, and Visa are great. But yeah, I think S&P Global is probably up there. I believe Booking and ASML are 3 to look at. I also think Uber's great. Dare Joe, I saw your dating advice a few AMAs back. Well, you got more of it now. My bro needs some advice from the master himself. What does it mean when a girl messages you to split the bill after you paid the check already? And what do women think about talking about investments on your first date? Just help us out. No material for videos. No material for video, thank you. You don't have to worry. I don't plan on using this in a video. All right, let me try to figure out what you're really asking here. What does it mean when a girl asks you to split the bill after you already paid for the check? I think I try to interpret things. I try to interpret things unless I really believe that someone has ulterior motives or nefarious motives. I try to interpret actions from people in the most favorable way possible. She's probably just being nice. Just like, you took me out. We had a nice time. I don't want to come across I think from her perspective, she probably thinks I don't want to come across as just believing you have to pay 100% no matter what. And I'm ungrateful is how I would interpret that. I don't think that it's nefarious, but obviously there's a lot of context missing. But if she's asking to split the bill, I think that's just a way of saying that she doesn't want to come across as ungrateful for taking her out and having a nice time. Now, I do think you should pay. I think the guy should pay when you go out for a date, especially the first time you're dating. So with my wife, I always paid when we were first going out and like getting to know each other. Once we started spending every minute of every day for months together, then it didn't feel like it mattered. Like she'd pay sometimes, I'd pay others. It doesn't matter. And frankly, like if you're going to spend, if you see yourself having a future with someone, like my wife and I's finances, it just goes, all of it's pooled into the same thing. None of us, there's no separate accounts or anything like that. So we were completely poor starting off our relationship. I remember one time I went to fill up my Honda Civic and my debit card declined because I didn't have $120 in my account. I only had $80 and you needed $120 to clear the charge for the gas station. So I had to call my wife and call my girlfriend at the time and say, hey, can you spot me like $50 for now? And until I get my next paycheck. I was working a customer service job. So, we've been poor together and none of that matters in the grand scheme. So I wouldn't read into it too much. I think she's just trying to be nice and not ungrateful. The question, what do you think about talking about investments on your first date? Very situational. I think it's probably not it's probably one of the least interesting topics possible for most young girls. I at least based off my wife, she does not care to just chat about investments. Naturally, we do a little because of my line of work, but it's just not an interest of hers. She'd much rather talk about like anything, family, friends, kids, any drama, television, like anything, almost any other subject than talking about the intrinsic value of Intuit. Like this is not a topic she's going to want to talk about. So I don't know. I feel like she's a pretty I feel like most girls on their first date aren't going to want to sit there and discuss the intricacies of ROCE and ROIC. Like you're just going to bore her to death. And I think mostly anybody at that point. So I don't think I would talk about it too much. On dates, I like to go places where you can actually get to know somebody, talk about them, try to figure out who you're actually talking to is what you want to do. If it's natural, if you work in investing, then you might talk a little bit more about investments on your first date. But I think it should be more geared towards figuring out who you guys are, trying to help each other figure that out. Again, I haven't, people say, oh, you're always dating when you're married. Kind of, but like, it's not the same. It's not first dates when you're married. I've been married for a little over 10 years now. And I've been on lots of dates with my wife, but yeah, I wasn't talking about stocks when we first were dating. Hey, Joseph, some more questions for you. Do you plan to bring historical dividend yield in the valuation tab? Maybe. It probably wouldn't be in the valuation tab, but we are going to create a separate charting tool where you'll be able to have you'll be able to create charts that have virtually every metric that you see from the earnings statements. So any of the statements, the balance sheet, the income statement, the cash flow statement, you'll be able to see those and be able to basically map out any bar chart or line chart, compare companies together, even throw in KPIs and do ratios as well. We're going to build that out eventually. And there you'll probably be able to select dividend yield and all these different things. But right now, it's just not as popular of one. So I don't know if we're going to throw it in right now. When using the DCF calculator, when do you prefer calculating the EPS growth and PE? For which companies you prefer free cash flow growth? Okay. I use which one I think best reflects a clear view and a more accurate view for the company. But in most cases, I like using both. For example, for a company like Texas Roadhouse, I probably use the earnings per share because it's so much more consistent. It's, the way that they do the accounting, it's a much more consistent view of what's going on with the company intrinsically. The cash flows are all over the place because they're opening up new restaurants and they're paying for them now. But then you get the returns of those restaurants next year and you generate more cash flow, right? So the cash is in and out, and it's harder to kind of gauge the free cash flow on a company like Texas Roadhouse, where a company like MasterCard, the free cash flow is super consistent. So free cash flow for MasterCard is a great one to use. So I think in most cases you want to use both and see how it looks on both of them. But I also think you should have a little bit more of a preference of which one is a more consistent view of the company that shows more accurately what's going on. But again, I would not blindly take whatever one makes the company look better and more undervalued. I'd use both of them and then try to draw your conclusions there. Out of all the exclusive videos you've recorded, which is your favorite and which do you think didn't get enough love and appreciation? My favorites by far were the 3-part series I did on Amazon and the perpetual undervaluation of big tech. I think it's probably the deepest, most insightful, like deep dive that I've ever done on a company. It cited the work of someone. I'm not sure. I think it's Nayut is his name, but it goes into an argument of how big tech has been perpetually undervalued for over a decade because a lot of incentives from big money managers. And the premise is based upon the fact the big money managers are unwilling to overweight big tech because it makes their job look not needed. For example, if an institution gives another money manager billions of dollars to invest that money, and they put all that money in Amazon, Google, Microsoft, and Apple, yes, they would outperform the market by a dramatic extent, but the big money manager charges a percentage, they charge a fee, and they need to justify that fee by making it look like they're investing in things that other people can't find. Therefore, they avoid obvious undervalued companies, obvious undervalued shares in the market like big tech. And they do that because of perception that they want to be able to market their fund and have all these, underappreciated companies. In reality, big tech has been a perpetually undervalued investment for the past 15 years, and it still likely is today. And it goes into Amazon specifically, how it's the least mature of all the big tech companies. It has the most upside. It's not optimized for profits. It will be later on. It goes into the money-making machine of AWS and the market share and all these interesting things. And that was a 3-part series. I think each of them an hour long. You can find it in the exclusive catalog. So just ask around the Discord and you'll be able to find that. Also wanted to congrat you on the Patreon membership milestone. Yeah, it's crazy. The community is growing here very quickly, which is cool to see. It's interesting when you're running a YouTube channel, you always want things to get bigger. I always have like anxiety, like, oh, are my numbers doing great? Are my videos doing well? But I'm like, it's like 70% bigger than last year. I need to take a breath and not concern myself that it continues to grow every month and that type of thing. So right now, this has grown so much bigger than I could have possibly imagined that I'm very grateful for how things have turned out with the YouTube. Hey, Joseph, in your recent video about 4 deep value stocks, I know you mentioned how there's a couple negative traits like lack of predictability that hold you back from buying companies like Adobe and Uber that are inherently high quality. But given how low their valuations are, and like you say, 9 out of 10 of these companies will end up making money for investors, why don't you treat buying these companies as more short-term trades that you would sell out of eventually if they get their fair value, or if you feel scared about their future potential disruption? It's a good question. Now, I do think that you can price in the risks of a stock and overprice them in. For example, Netflix in 2022 went down to below $200 per share. Okay, it's at $9.50 today. It's at $200 per share. And even with the risks in the stock, that was largely priced in. All the risks in the stock were priced in. Meaning that even if those risks played out and Netflix did have a huge level of disruption, you probably wouldn't have lost a lot of money from that point. So I do think that this can be priced in. And Adobe's getting there, but it's still not dirt cheap. Uber's not dirt cheap. It's cheap in today's market, but these aren't dirt cheap companies. And, I've really tried. One thing that I've really tried to do is not sacrifice predictability for valuation too much. I'll do it a little bit, but I just don't want to do that too much. Because what that leads to is naturally downgrading your portfolio to lower and lower quality stocks, seeking better and better valuations. And one thing you have to always understand as an investor is that there's always going to be stocks that trade at lower valuations than the ones you're invested in. Always, all the time. Any company that you can name, there's ones trading at lower valuations. And if you're always jumping ship from something you own to one that's lower valuation, and you sacrifice a little quality and a little predictability in the process, I think overall, you have a worse result. Now, again, the goal is for me is to not sacrifice quality for valuation. It's to find companies that I think are incredibly high quality, but the market does not fully perceive them as high quality because the market sentiment follows price, and the price is low. Netflix in 2022, Amazon in 2022, Meta for sure looked low quality, and boy, did the metrics improve on that one. That's one that I bought into it a little bit. I thought the company was becoming less quality based on the fundamentals. And Zuckerberg did the year of efficiency and things improved rapidly. But then you also have companies, people today are more excited to buy Google today than when it was $90 per share. $90 per share, it seemed like it was lower quality. So I'd rather wait till there's companies that I know are incredibly good quality, but they're trading down a little bit. And that's kind of the situation I'm looking for. So I don't know. I guess if I didn't own already so many companies that I think are so great, I'd be more eager to jump into these. But when I have companies like Booking and ASML and I have Google and I have Amazon, how many do I need? Do I need 15? Do I need 17 companies? I guess I could keep buying them, but for me, it's just so easy to add to some of the bets I already have. It's part of the reason that I haven't bought Spotify. I have Netflix. And I think, they're similar. They're both in content. They're both subscription companies. I only want to buy Spotify if it's like at a really big discount or something that's meaningfully more valuable than Netflix. So the way that I'm looking at it is through the lens of the fact that I already own a bunch of companies I think are high quality. I don't want to keep expanding the list without any limits. Joseph, if you were forced to allocate your entire net worth equally into just 3 companies today with today's stock prices, locked in for a decade with no ability to trade, what would you choose? And why would these picks uniquely justify a 10-year bet? Additionally, how would you balance your sector diversification and risk management in such a concentrated portfolio? Would you prioritize industries with long-term tailwinds or focus on companies with resilient cash flows and adaptability across cycles? No ETFs or index funds. Conviction picks only. Okay, so for this question where you don't have liquidity, you're saying one of the great things about the market is there is liquidity. It's not like real estate where it's really difficult and there's a lot of friction to buying and selling. So you're removing one of the benefits of the market, which is in the market, if you invest in a company that you perceive as high quality, but then there's new information that's revealed to you, revealing that it's lower quality than you have previously thought, you can sell that company and move on. That's one of the biggest benefits. If you got your analysis wrong and you miss something and you go, oh, wow, I didn't know this about the company, you can sell out of it and move to a company that's higher quality. When you take away liquidity, that makes it so that you're locked in for 10 years, no chance of selling no matter what information is revealed. That means that you need to focus strictly on the things that never change. Stuff that never changes. Companies that are so incredibly predictable that the chance of something happening to them that disrupts their business model is incredibly, incredibly unlikely. In that case, Microsoft would be one of my holdings. Costco would be one of my holdings, and Amazon would be one of my holdings. Not Google, not Booking, a contender, one of them, if you had extended the list to 4, I'd pick Netflix. There's a toss-up between those. I think that company is utterly predictable for 10 years. But yeah, I would put Microsoft, Costco. Costco, I'd probably have lower returns. So much is priced in. I might not make a lot of gains, but I know I'm going to have my money in 10 years. I know Costco is going to be bigger in 10 years. So, in that case, the 3 that I pick would not be the highest returning companies, but they would be companies that I know I would have a bigger, stronger company in 10 years. Other ones would outperform them, but those companies would have been more risky. They would have been more risky, and there's a chance that they would have failed. So I would pick Microsoft, Costco, Amazon. I think Netflix is the next one that I consider an extremely predictable company. All right, we're at 48 minutes here. Let's do a couple more. Hey, Joseph, hope all is well. 2 questions for you. Can you briefly discuss why the free cash flow of banks tends to be less consistent than some other companies? Yeah, someone else explained this. You don't use free cash flow when valuing banks. You use price to book. Have you considered getting into Chipotle now that it's hovering at 52-week lows? I'm keeping an eye on Chipotle. I've not really considered it. I think... I don't know. It'd have to go down a little bit. I'm not going to sell out of a company and buy it $10 cheaper. Like I'd need a more significant deal to get back into it. Chipotle was a great investment. I made, I think, 11 or 12,000 on that one. What's your reasoning for not owning Berkshire? Seems like a holding that fits perfectly with your investing philosophy. It might be my own stupidity for not investing in Berkshire. Maybe that's the case because it is a great company. I think it's, one of the most strong companies in the market in terms of resilience. Berkshire is going to also be around for 10 years. So if you wanted to preserve capital, that one's going to do well. Here's my issue with Berkshire, okay? The best investor in the world is Warren Buffett. Warren Buffett's very, very old. He's not going to be around for much longer. So you have the leader of the company going out sometime soon. And he's leaving them with a big problem, which is hundreds of billions of dollars worth of cash. Warren Buffett's the best capital allocator in the world, and he's not allocating capital. That's a problem. You would invest in Berkshire to have a company that buys the dip because it has so much money to buy the dip with. In 2022, it didn't buy the dip. In 2020, March of 2020, when stocks sold off dramatically, it didn't buy the dip. So I also don't see it buying the dip, and that's frustrating. I'd want this company to take advantage of great deals when companies are at very cheap prices. So that's inconsistent with what Berkshire used to do, where if there's a huge market panic and sell-off, they'd pick up cheap shares of companies that were reasonably undervalued. Another thing is that Warren Buffett and Berkshire's largest holding is Apple, which I personally think is overvalued, and I think that it faces many challenges. The DOJ might break up the deal between Apple and Google. That's a $25 billion a year deal for Apple. They have enormous exposure to China. You know, China isn't exactly happy with the US all the time, right? We're economic foes. So they can inflict whatever they want with Apple. The Chinese market's becoming highly competitive to Apple with AI phones that they're implementing at a faster speed than Apple. And, you know, all sorts of stuff with that. So between transitions with leadership, a huge stockpile of cash that's not being spent during dips, their largest independent investment being Apple, I just think there's other more straightforward investments that I currently choose to invest in. Hey, Joseph, I love Qualtrim website as it is very user-friendly. My question to you is, which service are you using to get the real-time data for stocks? What tech stack did you use to build Qualtrim.com? So this is a question I've had. I must have had. No offense to you, so I'm not singling you out, but I get asked many times about the tech stack. So it's built on AWS. That's where all the data's stored and locked down as in Amazon's web service. It's allowed us to scale really quickly. I'm sure you could use any of the cloud providers for Qualtrim, but Amazon Web Services works really well, and my developer knows it really well. And then in terms of the data, we use about 3 different data providers for Qualtrim, all for different parts of the website. And there's a few other APIs we use as well. So in all, we probably source data from 5 different companies, you know, and there's data for financial data. There's like earnings data. There's the AI stuff with the AI transcripts. There's like the instant news of why are stocks trading the way that they are. Like those come from different sources. If you're looking for like data providers, there's AlphaVantage is a great one. If you're just wanting to get really cheap data, that's pretty good. I would recommend AlphaVantage. Another one that's more expensive is FinHub. I think their data is pretty good as well. So there's a lot of them. There's a lot of data providers. You can go with the big guns. You can go with S&P Global, but it'll cost an arm and a leg. It's going to cost a lot of money to get data from something like S&P Global. So there's kind of levels to what you're doing, how far back the data goes, how high quality it is. We've made some trade-offs in Qualtrim. For the most part, the data is really accurate. It has some companies that will be inaccurate from time to time, but also Qualtrim has data that goes way, way far back. Most websites that are competitors to Qualtrim, they might advertise that they have more accurate data, but it only goes back 10 years. It doesn't go back 15 or 20 years or 30 years like Qualtrim does. So I like seeing long-term history with Qualtrim. It's something I think is really cool to go to a company like Amazon and see it all the way from 1998, right? I think that that's a really cool thing. I don't want to see just the past decade. I want to see before that. So, you know, there's trade-offs, but overall, I think the data is really, really good. It's sourced from multiples, and there's a couple you can check out there. That's going to be it for now. I hope you enjoyed the little impromptu AMA. Hope you all have a great weekend.